A company manages more money than the economies of most countries on Earth. It owns pieces of Apple, Microsoft, Amazon, Google, JP Morgan, ExxonMobil, Pfizer, and thousands of other corporations. When the financial system nearly collapsed in 2008, governments turned to it. When markets panicked during COVID, governments turned to it again. Its software monitors portfolios across the global financial system. Its executives speak with presidents, central bankers, regulators, and CEOs. And yet most people have never voted for it, never elected it, and may not even know they are financially connected to it. The company is BlackRock, and the deeper you follow the money, the more uncomfortable the story becomes. Because the biggest mystery isn't whether BlackRock owns the world. The biggest mystery is why one company became so important that governments repeatedly call it when the world economy is on fire. How does that happen? How does an investment firm become so deeply embedded in modern capitalism that critics begin calling it the world's largest shadow bank? And this is where the real story begins. Imagine waking up one morning and discovering that the same institution appears behind your retirement account, your pension fund, your stock market investments, your mortgage-backed securities, and some of the largest corporations on Earth. Most people assume economic power comes from governments. Others assume it comes from billionaires. But what if the greatest financial influence in modern history comes from a company whose business is managing other people's money? At first, BlackRock sounds almost boring. It's an asset manager, a fiduciary, a financial services company. Nothing about that description suggests extraordinary power. But look closer. By 2025, BlackRock was managing over $12 trillion in assets. Some estimates place the figure above $14 trillion when including recent growth. $12 trillion, $14 trillion. Numbers so large they stop feeling real. But here's the twist. BlackRock insists it doesn't actually own that money. And technically, it is correct. The assets belong to pension funds, retirement savers, governments, insurance companies, universities, and ordinary investors. So if BlackRock doesn't own the money, why do so many people say it owns everything? That question leads directly into the heart of modern finance, because ownership and influence are not the same thing, and influence can sometimes be far more powerful. The origins of that influence begin with failure. Long before Larry Fink became one of the most influential people on Wall Street, he experienced a career-defining disaster. While working at First Boston, he reportedly lost approximately $90 million on a bad interest rate bet. Most careers never recover from mistakes like that. Fink did something different. He became obsessed with understanding risk, not profits, not headlines, not prestige, risk. What dangers were hidden inside financial markets? What could destroy fortunes overnight? How could institutions see disasters before they happened? Those questions became the foundation of BlackRock. Ironically, the company that would later become one of the most powerful forces in global finance was born from one of Wall Street's painful lessons. And that lesson produced something extraordinary, a system called Aladdin. The name sounds harmless, almost magical, but in finance, Aladdin became one of the most important pieces of software ever created. Originally developed through BlackRock Solutions, Aladdin was designed to analyze risk, monitor portfolios, and help institutions understand complex financial exposures. Over time, major financial institutions began relying on it. Banks used it, pension funds used it, asset managers used it, governments consulted it. Suddenly, BlackRock wasn't just managing money. It was helping institutions understand the risks hidden throughout the financial system. And that's where the first major mystery appears. If information is power, how much power does a company possess when it helps monitor enormous portions of the financial world? Nobody knew the answer. Then 2008 happened. The housing market collapsed, banks failed, credit markets froze, families lost homes, retirement accounts were devastated. Millions of ordinary people watched decades of savings disappear. At the center of the storm were toxic mortgage-related assets that few people truly understood. Even the institutions holding them struggled to determine what they were worth. Governments faced a terrifying question: who could untangle the mess? The answer shocked many observers: BlackRock. In 2009, BlackRock was retained by the U.S. Treasury to analyze, unwind, and price toxic assets connected to institutions such as Bear Stearns, AIG, Freddie Mac, and Morgan Stanley. The Federal Reserve also allowed BlackRock to oversee portions of the $130 billion debt settlement involving Bear Stearns and AIG. Think about that for a moment. The financial system was collapsing. Trust in Wall Street had evaporated, and governments turned to a private asset manager for help. Why? Because BlackRock possessed something increasingly valuable: visibility. Its expertise in risk analysis made it one of the few institutions capable of navigating the wreckage. Supporters saw competence, critics saw influence, and what happened next would make BlackRock even bigger. While the financial crisis destroyed many firms, BlackRock emerged stronger. In 2009, Barclays sold its investment arm, Barclays Global Investors, including the rapidly growing iShares ETF business, to BlackRock for $13.5 billion. At the time, it looked like a large acquisition. In hindsight, it was transformational, because iShares sat at the center of a revolution called passive investing. Instead of researching individual stocks, investors could buy entire indexes. One click, hundreds of companies, instant diversification. The idea was simple. The consequences were enormous. Money flooded into ETFs, retirement accounts poured in, pension funds poured in, institutional investors poured in. Every year, more capital flowed into index funds, and increasingly, those assets flowed through BlackRock. Suddenly, the company wasn't just participating in markets, it was becoming part of the infrastructure of markets themselves. And this is where the story takes a darker turn. Look at the shareholder lists of America's largest corporations. Again and again, you see the same names: BlackRock, Vanguard, State Street. The same institutions appear among the largest shareholders of airlines, banks, pharmaceutical companies, technology firms, media corporations, and energy giants. Economists call this common ownership. The concept is simple. Competing companies often share the same major investors. Critics argue this could weaken competition. Supporters argue the effect is overstated. The debate continues. But the question remains: if the same institutions appear everywhere, who is really influencing corporate America? And who is actually signing off on these decisions? BlackRock insists the shares belong to clients, not the company itself. Independent academics generally agree with that distinction. But BlackRock also acknowledges that it exercises shareholder voting power on behalf of many clients. That's where ownership becomes influence, and influence becomes power. Imagine you're the CEO of a Fortune 500 company. Your largest shareholders include BlackRock. Not because BlackRock bought your company, but because millions of investors entrusted money to funds managed by BlackRock. When board elections occur, shareholder proposals emerge, or executive compensation comes up for a vote, BlackRock's position matters. Its vote matters. Its opinion matters. Its capital matters. That kind of influence doesn't require owning 51% of anything. And yet another twist was waiting. COVID-19, March 2020. Global panic. Markets plunged. Investors rushed for safety. Businesses faced uncertainty unlike anything seen in modern times. Governments scrambled to prevent economic catastrophe. Once again, the Federal Reserve turned to BlackRock. The company was selected to help manage major corporate bond buying programs established during the pandemic response, including facilities worth hundreds of billions of dollars. The decision immediately sparked controversy. Critics worried about conflicts of interest. A private asset manager was helping implement government programs affecting markets, in which it already played a major role. Supporters argued BlackRock was simply the most qualified institution available. But the questions wouldn't go away. Was BlackRock becoming too connected to fail? Was it becoming an unofficial extension of the financial system itself? Or was it simply the inevitable result of competence and scale? Nobody could agree. Then came another battle: ESG, environmental, social, and governance investing. Suddenly, BlackRock found itself under attack from every direction. Climate activists accused the company of not doing enough. Conservatives accused it of doing too much. Environmental groups pointed out that BlackRock remained one of the largest investors in fossil fuel-related industries. Meanwhile, BlackRock publicly promoted sustainability initiatives, and encouraged companies to consider climate-related risks. The contradiction was impossible to ignore. How could a company advocate sustainability while simultaneously holding enormous positions in industries linked to carbon emissions? Was this genuine reform, marketing, pragmatism? Nobody seemed satisfied with the answer. The controversy became so intense that some US states began pulling money away from BlackRock over ESG concerns. At the same time, activists protested the company for not moving aggressively enough. BlackRock had somehow become the villain to both sides, and beneath the political noise sat an even bigger question. Should private asset managers have this much influence over public debates at all? The deeper investigators looked, the stranger the story became. BlackRock expanded into infrastructure, private credit, private markets, data analytics, digital assets, even Bitcoin ETFs. Every year seemed to bring another acquisition, another expansion, another layer of influence. Meanwhile, governments and institutions around the world continued seeking BlackRock's expertise. Critics began using phrases like fourth branch of government and unelected finance ministry. Supporters dismissed those descriptions as exaggerations, but the fact that people were even asking the question revealed something important. Modern financial power no longer looks like traditional ownership. It looks like networks, connections, infrastructure, data, advisory relationships, risk systems, and access. That's the real revelation. The conspiracy theories are mostly wrong. BlackRock does not secretly own the world. It does not control every corporation. It does not dictate every government policy. In fact, many conspiracy claims surrounding the company have been debunked. But dismissing every concern would miss the bigger truth, because the real story is not about secret control. The real story is about concentration. When trillions of dollars flow through a handful of institutions, those institutions gain influence whether they seek it or not. When governments repeatedly rely on the same company during crises, influence grows. When shareholder voting power becomes concentrated, influence grows. When financial infrastructure becomes indispensable, influence grows. And influence accumulates quietly. The strongest revelation of all is surprisingly simple. BlackRock became powerful by solving problems. It solved risk management problems. It solved diversification problems. It solved institutional investing problems. It solved crisis management problems. Each solution attracted more money, more clients, more trust, more responsibility, and more influence. Step by step, decade by decade, BlackRock transformed from a risk management startup into one of the most important institutions in global finance. Not because it conquered the system, because it became embedded within it. So does BlackRock own everything? No. The assets belong to its clients. The shares belong to investors. The retirement accounts belong to workers. The pension funds belong to retirees. That part is true. But here's the realization that makes people uncomfortable. Ownership may not be the most important form of power anymore. In the 21st century, the greatest power may belong to institutions that manage the connections between assets, rather than the assets themselves. Institutions that sit at the crossroads of governments, corporations, markets, pensions, and investment flows. Institutions that become so essential that when the world economy faces its biggest crisis, leaders pick up the phone and call them. And that is why BlackRock matters. Not because it owns everything, but because it has become connected to almost everything. And in modern finance, that may be even more powerful.